Welcome to the Lend Academy podcast, episode number 170. This is your host, Peter Renton, founder of Lend Academy and co-founder of Lend It Fintech. Today's show is sponsored by Lend It Fintech USA 2019, the world's leading event in financial services innovation. It's coming up on April 8th and 9th, 2019 at Moscone West in San Francisco. We've recently opened registration as well as speaker applications. You can find out more by going to lendit.com/USA. Today on the show, I'm delighted to welcome Dan Quan. He is the former head of Project Catalyst at the CFPB, and that's their division that's focused on innovation. And so I've been wanting to get Dan on the show for a long time, but while he was at the Bureau, it was just not really possible. Now he has left, and he has actually just recently written an op-ed in American Banker, which we talk about in some depth. We also talk about what the role of government should be in encouraging innovation. We talk about some of the wins that Dan had at the CFPB with Project Catalyst, why the work they're doing is important, and really, what it should look like going forward and how the government can really encourage financial innovation. It was a fascinating episode. I hope you enjoy the show. Welcome to the podcast, Dan.
Thank you, Peter, for inviting me.
Okay, so let's get started by giving the listeners a little bit of background about yourself and what you've done in your career to date.
Sure. Again, thank you, Peter, for inviting me. This is a great opportunity to introduce myself to you and to your audience. Since, of course, we have known each other for quite some time. Mm-hmm. So I started my professional career as a management consultant, helping Fortune 500 companies and the large private firms to manage the financial risks posed by their pension plans. Then, since I always had an itch for politics and policies, I ended up going to Harvard Kennedy School and spent 2 years there, and that's where I developed a strong interest in consumer finance. So after Kennedy School, I worked for Professor Peter Tufano at Harvard Business School, who is a guru of consumer finance. Around the same time, he left Harvard for Saïd Business School, so he's now the dean at Saïd Business School at Oxford. I also came down from Boston to Washington, D.C. and joined the Consumer Financial Protection Bureau, or CFPB. Mm-hmm. At CFPB, I started my tenure at CFPB working in their policy shop called the Research Markets and Regulations. I was in the markets group, specifically on the payments team, monitoring emerging payments, mobile payments, cryptocurrencies, that kind of stuff. Then after about 2 years, I joined Project Catalyst, and that was in summer of 2013. I believe that was 6 months after the initiative was launched, and I had been leading the office ever since.
Okay, so you were at the CFPB pretty much at the beginning, then I take it, right when, right after it was founded, right? If you like it says here on, is it 2011 that you started there?
Yeah, that was July 2011. So I think 2 weeks after I started, maybe a week after I started, the CFPB officially opened its door.
Okay, so that was the very
early on. Yeah.
Okay, so then, so tell us about Project Catalyst. That's sort of how I've gotten to know you over the years. We're running that effort inside the CFPB. Tell us about why it was started and what its mandate was.
Right. So the mandate actually is very simple. Has been very simple. I even think even with this new Office of Innovation, when it was announced in the setup, the mandate hasn't really changed per se. So the mandate has always been to promote consumer-friendly innovation. But honestly, back then, Peter, fintech was just a term. I don't think the term of fintech was as popular as it is now, as it is today.
Oh, for sure.
We literally, frankly, as a new agency, we sometimes call us a startup. We had no idea what we were going to do, but we just felt that this was the right thing to do. We see so many innovations were coming up from Silicon Valley, from New York, from all parts of the country and the world that Washington, D.C. just was not ready to really handle, to understand to start with. So we believe the first thing we should do is really trying to get to understand them better and see what these people are trying to do and what sort of implications are for policies, for regulations. So we had flashy PowerPoint slides back then, but frankly, in a gist, we didn't know what to do other than, we'll do more outreach. We will do what was maybe running some pilots, maybe get some more data, maybe start developing the trial disclosure policy. I think that was just early on. So when I joined this initiative, I frankly didn't have a very full idea how we should make this office work. But the first thing I did was I told my staff, I want to be the first. And what that means is I want to be the first. We will not be the first to develop these innovative products and services. These are the jobs for the VCs, for the entrepreneurs. But I want to be the first, or the Bureau wants to be the first to really identify these new things, the new trends. And we want to be the first to think about the right policies, long-term and short-term. So naturally, we were, and I think that the sort of, I think my idea actually worked. And we were the first one, I believe, to look into cryptos. Back then it was only Bitcoin. That was even before Ether was created.
Mm-hmm.
That was Bitcoin. And I spent a week in San Francisco in the Bay Area and meeting with Coinbase, with other financial VCs, entrepreneurs. We're trying to think about how to take advantage of this new development, which was really, really, even today, was still quite stunning for many of us in the financial services space. I think I missed the first land date because that was in San Francisco. It was very small because I had a conflict. I couldn't go. But I think I've attended land date ever since, every land date. I've never missed one. Mm-hmm. And I think the Project Catalyst office was the first one that actually recognized the sort of the emerging trend in marketplace lending, in peer-to-peer lending. And even today, after many of the companies in the peer-to-peer space have become so big, they're sort of out of the normal portfolio of Project Catalyst. But these founders and CEOs still tend to call me and email me when they have questions, which shows how strong the relationship we have built with these firms when they were still young and were just coming up. And that was also very not a surprise to a lot of people that Upstart, being a marketplace lending platform, was the first one that received a no action letter from the CFPB. So those were the relationships that we were able to build over the years with these companies, such that we understand what they're trying to do. We understand their pains. We understand the problems they're faced with. And we're also trying to take that perspective back to the CFPB and to Washington, D.C., and have a much bigger, larger conversation about these issues. And hopefully we can use the authorities that we have to remove some of the regulatory uncertainties that they're faced with. And not to mention alternative data, machine learning, and the consumer permission data access. I think the Project Catalyst office has done a fantastic job in really bringing these topics from thousands of miles away on the West Coast and to Washington, D.C., and have an open dialogue about these issues. So I'm very proud of the work that we have been doing.
Mm-hmm. So let's just talk. You mentioned Upstart there, and I definitely wanted to bring that up because that was a pretty seminal moment for the industry when you sort of Upstart was issued that no action letter from the CFPB. And because there'd been question marks about it over the years, and about because they're using alternative data, and they've proudly kind of said that their underwriting was different to everybody else's. So tell us a little bit about that particular process and how you were able to get comfortable with what they were doing and issue that no action letter.
Well, all I can say is it's not easy, and I have grown a lot of gray hair during that process and after that process, for sure. But honestly, I think the company has done, since I'm no longer a public official, so I can talk about things more candidly. Right. So I'm very proud of the things that we have accomplished together on this no action letter. I think the company has done a lot of good work. I think I gave Dave and his team, Allison and Paul, a lot of credit for their bravery, right? So speaking to a federal regulator, in many people's mind, is a huge risk. Right. And to give them everything that you pretty much don't have to, of course, unless you want to apply for something and get something in return, is also a huge risk by a lot of people. I think the team has done a fantastic job in sort of trusting the Bureau, trusting the Catalyst office, and trusting the Fair Lending office at the CFPB to really share information in a very candid manner. And we actually went through the process, and we look at the things they have done, the algorithm they have developed, and frequently changed, adapted as they get more experience, get more data, get more loans on their books. And frankly, we finally got very comfortable that, number one, there is a potential for this underwriting model to expand access to credit in a responsible way. Number two, there's always fair lending risk. And fair lending risk is not a static issue. It's evolving, right? You may not have a fair lending problem today. That doesn't mean you didn't have it yesterday or you won't have it tomorrow. But the key is really having a right process in place to monitor, to ensure when a problem emerges, you have a way to handle that, to tackle that. And I think that's really sort of the goal of such a no action letter to Upstart. So if I can just tell you sort of three takeaways from this Upstart no action letter. Number one, I think this no action letter shows machine learning and the use of non-traditional data, as controversial as they might seem on surface, they do have the potential to expand access to credit. Number two, disparate impact as a legal issue. There's a legitimate debate how this should be done, whether this should be done or not. But I think I'm a very realistic person. I believe every institution, every lender should take its best effort not to discriminate against protected classes. And I don't think anyone wants to do that, if you're a responsible lender, of course. So disparate impact or fair lending is very important that every lender should think about day in and day out. Number three, with these new innovative methods, such as machine learning, such as the use of non-traditional data, or the combination of both, there is still a pathway to compliance. So just because you're using machine learning or the non-traditional data, that doesn't mean you're automatically violating the spirit or the letter of the law. In fact, there is a way for it to move forward to comply. Of course, a lot of the things that we have done with Upstart during the process and also as part of the compliance agreement, that information is still confidential.
Sure.
But I hope through this experiment and hopefully when the CFPB is thinking about launching its a sandbox, I hope there will be more firms that can get into the sandbox and work with the CFPB to test the new things. And I think with Upstart, we only cover a important but also still a very limited area. I think there are a lot of areas that the CFPB can really help remove the regulatory uncertainty or the mystery around these issues, such that not just firms like Upstart, the newcomers, but also incumbent financial institutions can also have a chance to really test these new things. Because these are really, really powerful tools that can not only, as I said, from the policies perspective, expand access to credit, helping people like new immigrants, people like women, people like young people who actually we call fallen angels, right? So they had a good credit, but they failed, then they try to pick up and get back to the credit mainstream. I think these methods can be really, really useful to do that. So that's good public policy outcome. But from the business side, these methods can make the underwriting models more robust, can reduce default, and what that translates into, if you're a big institution, that's millions or billions of dollars savings.
Right, for sure. So then I want to take a step back, and you sort of touched on it, but I want to sort of talk about the role of government a little bit holistically. I mean, you were in the CFPB for more than 7 years. You had a sort of a front seat role to a lot of the innovation that was happening in financial services. But the CFPB is obviously, it's about consumer protection. So you've got this, protecting the consumer on the one hand and all this exciting innovation happening on the other hand. So when you think about that sort of those two things holistically, how is the government supposed to balance those two things?
Yeah, it's a very important question, and frankly, I don't think anyone has a sort of a perfect answer for that. And maybe there's no perfect answer. So I oftentimes use the sort of the 5% rule of thumb. Well, what I mean by that is an agency such as the CFPB, or take any agency, the OCC, the FDIC, the Fed, or SEC or CFTC, any of those regulatory agencies, they should spend maybe 95% of their resources and time thinking about or helping institutions that they supervise to comply with the nation's laws and rules, such that people are not harmed, institutions are secure and safe. But there should be also another 5, maybe 10%. I don't know what the number is. This is just a very sort of, it's more of an idea. They should spend some time, not just within one office, maybe starting with just one office, such as the Innovation Office or Project Catalyst at the CFPB, but ideally across all the offices or divisions within the agency to really think about what's next, what's coming. And the goal is not really about, I'm going to police all these new things, or any new things is scary. New things can be very scary, I can tell you. But they don't have to be, or at least the people who actually think about these questions shouldn't take a very adversarial position towards the new things. They really think about, okay, so technology is going to change our lives no matter what the government does or doesn't, right? It's the fact. We cannot really stop what technologies will bring to our lives. So a more collaborative attitude is let's really first not take an adversarial position. The second, try to understand what these things are going to do to consumers, to the financial institutions that offer these products, to our financial system. Is there any safety soundness issues that we should be concerned about? And number three, is there a way for us to allow these things to be further developed, to be tested? And maybe think about now this sort of sandbox thing can come up, allow these things to be piloted. And the reason is when you don't have a good amount of information about these new things, it is very dangerous for you as a regulator or policymaker to set guardrails to regulate these new things. Because I think 9 out of 10 times, whatever you were trying to do may end up in a not perfect place, and you either over-regulate or you actually not regulate enough. So I think there needs to be some kind of a balance between innovation and consumer protection. And also, I want to say, one of the very famous VCs and entrepreneurs in the Silicon Valley once told us, I'm not going to mention the name, what this person told us was pretty much since the financial meltdown from 10 years ago, with all the firms that he has seen and companies that pitched to him, or the VCs in general at large, who are actually reviewing these sort of deals, opportunities, by and large, there's nothing that's 100%, but by and large, 99% of these companies are really trying to do the right thing.
Right.
No, now the company trying to really help harm people. Along the way, they may do stupid things, of course, but technology, by and large, is trying to be developed by these people to help consumers to really make the products and services more efficient, more effective. And I think this is something that as regulators we should feel comfortable with. And frankly, maybe I have a very limited sample size, but frankly, most of the companies that I've dealt with, I've spoken to them, met with, and some of the CEOs, founders have become personal friends with, I think they truly believe what they are trying to do, not trying to scam people, not trying to harm people, and trying to develop a better products to make people's financial lives better.
Yeah. Okay, that makes sense. So you left the CFPB in July, and we reconnected. You also, you wrote an op-ed in American Banker just last week, as we're recording this in mid-September, and in it you laid out a pretty clear plan of what you think the CFPB sandbox should look like. And maybe, I don't want you to sort of recite the entire article, but maybe for those who haven't read it, just give us, just tell us some of summarize like the points of what you do think that it should look like.
Sure. So unfortunately, the op-ed, there's a word limit.
Right.
Probably it's only like 800 to 1,000 words, and I think the editor was very nice with me, and she told me, if you exceed the word count, that's fine, as long as it's not too lengthy. So anyway, so it's not a policy paper, so I cannot really put everything and give very detailed explanations for everything that I was trying to make. There are a lot of points I want to pack into the op-ed, but maybe I can just break this thing down into maybe two parts. One is the long term, the other one is the short term. Mm-hmm. So in the longer term, I think in a way this is probably the most important message. Unfortunately, this probably is not really appreciated by many readers, because I think naturally readers will think about, even given the title of the op-ed is about the sandbox. But what I'm trying to say, maybe I'll write another op-ed in the near future about my views on the sandbox. I think the real hard work and what I call unsexy work is really think about the long-term policies and rulemaking. Because these are the things that are not sexy, tend to be controversial, and really not attract much attention from the media. But the longer-term goal for any agency, in this case, this op-ed is about the CFPB, is really think about, you have to run these experiments through the sandbox. You have to learn a lot. But what are you doing with the rules on the books that are sort of outdated, that are sort of impeding consumer-friendly innovation? Are you willing to? Do you have the will to change the rules And that's a much important task to do. And in my view, in an ideal world, and use analogy of driving, right? If you have proper insurance and a valid driver's license, you don't need to get the permission from DMV every time you get on the road. That would be absurd. The same thing here. Companies should have the comfort from their regulators that as long as they're doing everything in compliance, they shouldn't need to get a permission from the regulator. But, that's the ideal world. We're not there yet. Hopefully we'll get there someday, hopefully in my lifetime. But that's a much longer term goal. And that's something that the Bureau should spend more time thinking about doing. The short term, obviously, it's all about the sandbox, right? And I think the most important thing for the agency to really realize is what exactly is the sandbox about, right? So the first thing you have to do is really lay out to the public, right? Tell the public in a speech or in some kind of op-ed or blog post, tell the public what the sandbox, what kind of issues or problems that the sandbox tries to address. And I think that's the two things that I sort of lay out for the public, for the Bureau and to the public, that is regulatory uncertainty and regulatory fear. Uncertainty is something that has been talked about and written about for a long time. A lot of people are familiar with what that means. Regulatory fear is something that a term that I coined. And I think this is from my experience when I was running the innovation office at the CFPB. So many times companies will come to me and say, here's my product. It's new, never offered by anyone before. And I've checked with my lawyers. They have told me that I'm doing everything in compliance with the rules that the CFPB is in charge of. Can you give us a approval? And I said, no, that's not my job. Because if you are in compliance with everything that you're doing, then why would you worry about the CFPB? And the answer is, well, my partner, especially my partner, if the partner is a bank, will say, what does the CFPB think? Because I'm not going to do something that has never done before and get slapped with a enforcement action or supervisory action by the CFPB for doing this, because I want to make sure they understand what we are trying to do here. Mm-hmm. So I think this is a very sad reality because, as I said, if the rules are clear, if you are doing everything in compliance, you don't need the CFPB to give you approval. And I think in this case, the rules probably are pretty clear. It's just like the novelty of the product they're very uncomfortable with. So longer term, again, I think you shouldn't come to the Bureau, to any agency to do this. But in the short term, a sandbox can be useful for the CFPB to take more initiative, to encourage more trials, more pilots, more testing of new products and services, whether they need some kind of safe harbor or not. I think that's a very important thing for the CFPB to do. Now, I mentioned the approval authority in my op-ed, and later on I also posted a LinkedIn note because some people were asking me where are the approval authorities in the three statutes that you referenced in your op-ed, which are TILA, ECOA, and EFTA. So I put out these provisions in my LinkedIn post. So a lot of people have seen that, which is good, I think. So this is an authority that has been rarely used in the past. If memory serves, it was only used once or twice, probably by the Bureau. I don't think the Federal Reserve ever used it before. Mm-hmm. But it's a very powerful authority. In essence, what this is, the CFPB can basically deem someone or some product in compliance with regard to, of course, these three statutes. If it's beyond the three statutes, the CFPB does not have the authority to approve something. And this product can be just one product or can be a category of products. So the nice thing about this approval authority is really about that. It's really that there's the kind of certainty that the approval gives to the institutions. Because unlike the no action letter, which is a staff recommendation, which is non-binding, the approval authority is binding. It's agency action. Mm-hmm. Of course, the downside is if somebody sues the CFPB, you have to go to court to defend. But by and large, this has never happened before. But by and large, the courts in such cases will most likely defer to the bureaus because this is the statutory authority that Congress gives to the CFPB. Now, I'm not saying the no action letter or the trial disclosure waiver policies are not important, but for sure, compared to the approval, they're less important. But they do have other usages that the approval authorities doesn't have. So again, one is the three statutes, right? Beyond that, you probably, if you want to do something, you probably will need the CFPB to issue a no action letter. The waiver authority on child disclosure is also a very interesting thing, and that's the first thing that the new innovation office rolled out for public comment. I do think disclosures are very important, but I think importance is also a relative thing. So compared to the no action letter and the approval, I do think disclosure testing is less important, mostly because from my experience, again, this is about innovation, right? I've never heard anyone actually telling me that because of the disclosure rules here, I cannot create or offer this new product. It's never been a obstacle for innovation. But there are legitimate complaints about the effectiveness or whether the disclosure rules, certain rules are too burdensome. I think these are very fair comments, and I do encourage the Bureau to look into these things and figure out ways to improve disclosures. But if the office is, or if the Bureau in the sandbox is focusing on innovation, if you spend more time on disclosures, that is not the right sort of use of resources. So the Bureau should, in my mind, really focus on the approval and the no action letter. These are the two powerful tools that the Bureau can further develop. Of course, the approval has not been developed yet. There needs to be processes in place to make it work. And the no action letter policy, obviously, the scope and also there are a lot of things in the policy, and a lot of people have written about it. I don't need to repeat them. Very good points to further enhance the effectiveness of the policy.
Right. Yeah.
So sort of these are the things that I'm trying to argue in the op-ed. But I do hope, and I think this is a very important message, the Bureau should focus on the long-term goals of all these exercises. There's a danger that when agencies roll out these sandboxes, they think that will make them look very innovative, look them very forward-leaning, very good. But sandboxes are merely tools. They are not the end. The end is really making sure you have the right rules in place such that everyone can comply with, and they don't have to come to you for any kind of permissions or one-time permissions or approvals.
Right. No, that's a very good point. So, and I look at that, and I think, like what the example you gave about, someone working with a bank partner, and the bank's partner says, "Oh, that's never been done before. I don't want to be the first." It would be so great to have a framework in place where, for things that for big banks or people to get comfortable, so they don't mind being the first if they've got this kind of framework in place. But I want to get your perspective on, because we live in obviously a very globally connected world, and we know that there's plenty of different regulators around the world doing different things with sandboxes. Particularly, I'm thinking about the UK and Singapore specifically. How has your view of the whole sandbox concept been informed by what other countries are doing?
Right. So I have been in touch with the FCA, the Financial Conduct Authority in the UK, since probably 5 years ago, 4 or 5 years ago.
Okay.
They actually came to the US, came to the Bureau to sort of learn from us our experience with Project Catalyst, and they later launched Project Innovate, and they have progressed so fast. They are the true, what I think, a true leader in not just in sandbox. Sandbox again, I don't want to talk too much about sandbox. I do think they are the true leader in promoting innovation, in promoting fintech to benefit consumers and to benefit the economy at large.
Right. So
in terms of my views informed by them, I do think, obviously, the first thing we have to recognize is we have a very different regulatory structure in the United States. And whatever the FCA or Singapore's MAS have been doing, you cannot really transplant what they've been doing to here. That's not going to just work. A large part of what they can do is really about licensing, which the Bureau doesn't have any authority in issuing licenses. Chartering is the job of the OCC and the states, and we don't have that chartering authority. And specific licensing is done to non-bank institutions, are done at the state level, and again, the CFPB doesn't have that authority. So those things, the specific policies in the sandbox at the CFPB are going to be very, very different, and they are. And based on the blueprint that I devised for the Bureau before I left, and based on what I argue in the op-ed, very, very different from the FCA or the MAS, Singapore. But I think the common theme here is this, and I think I've learned quite a lot from my friends and colleagues at the FCA, which is really their mentality and their long-term thinking. So they have a very clear strategy. They are not just doing Project Innovate for the sake of being cool, being sexy. They're not doing sandbox. They are the first one, by the way, to launch a regular sandbox. And they have done, I think, 4 cohorts so far. They're not doing this just to show them, hey, we are good. Actually, they are actually thinking very carefully about what exactly these tools that they're using, they're developing, they're fine-tuning to achieve. And I think along the way, they have done a fantastic job in really changing the culture of the agency. And I think in this case, I wanted to give Tom Curry, the previous Controller of Currency at the OCC, a lot of credit for, first of all, acknowledging the culture issue within their agency. And I think the issue is not just with their agency, but I think it's across the board with every agency. This is a sort of the 5% thing that I talked about previously. It is about a lot of agencies, and most agencies probably, when they see these new things, their knee-jerk reaction is, oh my gosh, I don't understand this, so I don't want to deal with it. So that is not really helpful. I think the OCC, when it was under Tom, in their first white paper on responsible innovation, they acknowledged that issue and they wanted to figure out ways to tackle that. And I think this is the issue that every agency has been struggling with. And I think, frankly, the FCA, my understanding is they also had a similar growth pain, and they also wanted to address that issue. But I think they are probably the most successful in doing that, and there's a lot for us to learn from them. Us meaning not just the Bureau, but also all the agencies, regulatory agencies in the United States, to learn from them, their experience. And, I truly think agencies need to be a little bit bolder, a little bit more brave to really embrace new things and to figure out the ways to really balance the innovation and the consumer protection. And I think that I'm not saying the FCC is perfect. I'm sure they have made mistakes, but I think they are really, in my mind, the most thoughtful in a leader in the space. And I think there's a lot for the regulators in the United States to learn from.
Mm-hmm. Right. No, I completely agree. So anyway, we're running out of time, but before I let you go, I want to, you left the Bureau a couple of months ago now. So what are you doing, and what's next for Dan Quan?
Probably writing more op-eds. So listen, Peter, I have, as you said, I've had a strong row seat in the fintech space for quite some time. I've built a very strong network. I've made a lot of friends in the space, and I truly, I'm very passionate about what I'm doing here, what I've been doing, and the issues that I've been advocating for, and the fantastic business models that I have witnessed. Some of them are actually starting from very, very beginning, they're really ideas on a piece of paper. They have become, and those firms have become, very prominent and very big in doing what they have been doing. So I don't know what I really, it's too early for me to say what I ultimately land. And I can say I'll continue to be active in the fintech space, and when the right time comes, I'll let you know. Okay, well that's good news. I mean, we certainly would love to have you still actively involved in our space. You've done a tremendous job over the last several years of really encouraging innovation in fintech, and also for fintech companies to proactively engage with regulators. And I think that's been a real gift to the industry. So anyway, we'll have to leave it there, Dan. I really appreciate you coming on the show. Thank you very much, Peter, for having me.
Okay. See ya.
Bye-bye.
It's not an easy thing for government to really balance this, consumer protection and encouraging innovation. I think Dan sort of lays it out pretty well here then in what his vision is to be able to do that. And, I think what, from my perspective, is we certainly do not want to stifle innovation. This country has had some amazing technological breakthroughs, not just in finance, but in other areas over the last several decades. And, and some of the American companies are some of the largest companies in the world because they were able to produce innovation that was that was better than what others were doing. It's not a guarantee that will stay going forward. There's lots of other countries and foreign companies that are looking to beat the US in the innovation area, particularly when it comes to financial services. So I think, I hope Dan stays in the industry. It sounds like he is. I think his sort of expertise is something that we really need in this industry as we try and bring, more innovation, more responsible innovation into finance. Anyway, on that note, I will sign off. I very much appreciate you listening, and I'll catch you next time. Bye. Today's show was sponsored by Lend It Fintech USA 2019, the world's leading event in financial services innovation. It's coming up on April 8th through 9th, 2019 at Moscone West in San Francisco. Registration is now open, and we're also taking speaker applications. You can find out more by going to lendit.com/USA.